IOI Properties is planning to spin off nearly $8 billion, $10.7 billion in real estate assets across two separate REITs in Malaysia and Singapore. If you only read the headlines, this looks like a standard growth story, a developer monetizing assets to build more. But if you look at the balance sheet, the story changes. This isn't just about growth, it is about survival and sustainability. With net gearing potentially spiking to 0.93x following the massive South Beach acquisition, IOI Properties is sitting on a mountain of floating rate debt that is increasingly expensive to service. For Singaporean investors, especially those of you chasing yield for your SRS or cash portfolios, this dual listing presents a unique, albeit complex opportunity. But is it a buy? Let's dig into the numbers. IOI Properties isn't just launching one REIT. They are attempting a rare dual market strategy. They plan to package their Malaysian retail assets into a Bursa-listed REIT 2026 and their prime Singapore office assets into an SGX-listed REIT 2027. Here's the breakdown of the proposed split. The Singapore leg of this deal is the heavy hitter. The South Beach Complex and IOI Central Boulevard Towers are absolute trophy assets in the Marina Bay district. South Beach, IOI, recently paid $834 million to buy out CDL's stake, taking 100% control. Central Boulevard, a massive 1.26 million square feet office tower that is slowly filling up, 88% committed occupancy. Be careful not to confuse trophy assets with trophy returns. Trophy assets often come with trophy price tags and lower capitalization rates, yields. While owning a piece of Marina Bay sounds prestigious, as dividend investors, we care about the spread between the property yield and the cost of debt. With Singapore's office cap rates compressing, the margins here might be tighter than you think. Why go through the headache of two separate listings? Debt. IOI Properties is currently holding a significant amount of debt, much of it denominated in SGD to fund their Singapore expansion. With interest rates staying higher for longer, this debt is eating into their core net profits. Current gearing is around 0.7x. Projected gearing is about 0.93x post-South Beach funding. Interest sensitivity is high. About 79% of borrowings are SGD denominated and floating rate linked to SORA. Every time the US Fed or MAS tweaks rates, IOI feels it. By spinning these assets off into REITs, they can offload debt, transfer the mortgage to the REIT entity, and recycle capital to get cash upfront to pay down parent co-debt or fund the new W Residences Marina View project. The success of the Singapore REIT listing 2027 hinges entirely on the Singapore office market. Right now, the market is sending mixed signals. Bull case. Return to office mandates are sticking and supply in the CBD is tight. Bear case. Tech layoffs and hybrid work are structural headwinds. IOI Central Boulevard Towers is a massive injection of supply. While they report 88% committed occupancy, remember that committed does not always mean rent paying. There are fit-out periods and rent-free incentives that delay cash flow. There is a specific risk here called concentration risk. This proposed Singapore REIT would essentially be a play on just two massive buildings. If one major tenant leaves Central Boulevard or South Beach, the DPU, distribution per unit, gets hit hard. Unlike a diversified REIT like CapitaLand Integrated Commercial Trust, CICT, which owns dozens of malls and offices, this IOI REIT will be a pure play on Marina Bay offices. Pure plays are great when the sector booms and terrible when it busts. We have 2 years before the Singapore IPO. Here is how I am looking at this trade. The parent co arbitrage, currently IOI Properties, the parent stock listed in KL, is trading at a discount to its book value price, book about X. If they successfully pull off these REIT listings, they unlock huge value that is currently trapped on their balance sheet. The market is pricing them as a risky developer. The REITs turn them into an asset manager. The REIT IPO, wait and see. I am not excited about the Singapore REIT yet. Interest rates, we need SORA to drop further for the yield spread to make sense. Valuation, IPOs are usually priced to benefit the seller, IOI, not the buyer, you. Currency, if you are a Singaporean investor, you don't want the Malaysia REIT, MIR weakness risk. You want the SG REIT, but only at the right price. I am officially categorizing this as a watch, don't touch for the REIT itself. However, the parent company, IOI Properties Group, is the more interesting alpha play right now. If you have access to Bursa Malaysia, you are buying the seller of the assets, not the buyer. You buy the company that is about to receive an $8 billion liquidity injection. If you are strictly an SGX investor, keep your powder dry. The office market is softening. Let the IPO launch, let the hype die down, and let's see if we can pick it up at a discount to NAV in late 2027. If you found this analysis valuable and want to stay ahead of these complex market moves, consider becoming a free or paid subscriber to the Substack. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching. Stay safe in the markets, and I'll see you in the next analysis.